Good day, fellow investors. Where are the opportunities in these markets today? There was this comment by Tobias, how he wants me to discuss the 6 top stocks of the S&P 500, but I'll take that as a context builder for discussing where are the opportunities. But I'll take that as a context builder to discuss where are the opportunities. Let's start. Just got an email from GMO discussing the risk and reward of investments across the globe, 7-year asset class, real return forecasts, and you can see that US large is at negative 4.1% estimated real returns over the next 7 years, which means you're going to lose 4 times 7, about 40% of your purchasing power by investing in US stocks. On the contrary, and that's also what we're going to discuss, you're going to make real returns if you invest into emerging value. Let's immediately start with the US, just to discuss the risk and reward so that you have something to compare with what are the investment opportunities in this market, and we'll close this video with the opportunity. So top 7 I think I've done from the S&P 500, and let's start immediately with Microsoft. And you have these businesses that were stagnating, now they are booming on AI, but the P ratio is 37. Okay, if you look at revenue growth over the last few years, it has been pretty strong and very high for Microsoft. Mid-teens on average, slow down a little bit, but if they continue like this for the next decade, then the P ratio might be warranted. However, if you look at the other side, there have been also periods when Microsoft grew at 5%, regulatory, AI, delays, whatever. So there is a lot of growth baked into this. It could happen, it might not happen, definitely not a value investment. And then also, if you focus on the P ratio of 37, such a high P ratio is based on the assumptions that the Fed will cut rates heavily over the next year to 3 years. But if you look at what they are saying, they don't know. They simply don't know. The Fed could cut rates. There might be, if the data softens over the next 3 to 5 months, it could happen, it could not happen. Similarly, Apple, you see the P ratio is close to 30. I did buy Apple in 2016 at a P ratio of 10. What is now so different than it might not happen again? Because if you look at revenue growth for Apple, actually now it is declining, but the P ratio is still 30, and 30 we don't know whether there will be justified for that growth, etc. But if you look at the stock price, you see this huge growth, and then you say, Sven, it's all about the buybacks. Yes, they are spending 10 billion on buybacks to keep the stock high, but the key risk here is that if revenue slows down, if people switch just a little bit from the iPhone and they don't have 100 billion but only 50-40 to do repurchases in 1 year, this can easily crash 50-60%, and then all these buybacks are wasted money. Because if you look at the number of shares outstanding from Apple, yes, it went down, but you can see here, as the stock price goes up, the yearly buybacks go lower and lower, and we are now spending 100+ billion on buybacks for a 2.41% yield on buybacks, plus the minimum dividend. So we have a 3% yield from not growing company that just financially engineering the stock price higher and higher. Nvidia, just recent news. Again, this is trading. Even if I adjust for 4 or 5 quarters, 100 billion in revenue, this is trading at 25 times earnings now that the stock goes up. And you can see here this hockey stick situation, which means there is a lot of exuberance. I don't know what will happen, nobody knows, but the market likes to take the risk. A little bit less exuberance you see here with Amazon, but still, P ratio 30, I think They can make about 50 billion in value, 60, but that's still a ratio of 30 on the valuations there. And we don't know where will Amazon be in the next few years, but we also discussed here how if they plan to effectively manage dilution, just that costs 30 billion, and that's more than 50% of their profits. Google, and you see here less hockey stick environment, P ratio of 27, so more long-term confirmation of the business, slower and steady, but still they are now focusing on buybacks, pushing the stock price higher, but still a P ratio of 27, perhaps the cheapest there, but you never know. This in a recession can easily come back. Meta, similar P ratio, now what was it? Metaverse, now it is AI, but again, if the market ever reverts to risky, no hockey stick here, P ratio of 20, Warren Buffett, huge cash pile, selling Apple, thus explaining the risk of the companies we just discussed. So the cheapest of the 7, and if I had to buy something here, if you give me $1 million, put a gun to my head, I would buy Berkshire. P ratio of 27 for the S&P 500, and also the guidance for long-term returns, real returns, is made on the average P ratio. If this happens on average inflation, average interest rates, then the market is down 40%. But we are still now exuberant, and exuberance sooner or later passes competition, regulation, monopolies, whatever, all that we have looked at in the early 2010s with Microsoft, etc., will happen again with Nvidia, and that's how the story circles. The stocks go up and down, but the most likely outcome, anything can happen, is a negative real return, because the current yield is very low, and as I said, yes, even Google is spending on buybacks for the last 3 years heavily, 60 billion now, but that's just a yield of 2.2% adjusted for share issues. That's really nothing. Apple, 2.4% diluted. So better to look elsewhere for opportunities, and let's look at emerging value. Let's take Indonesia as an example. The economy is expected to grow at 5% on average in the future. You see here, debt to GDP is just at 40%, not at 100 plus like the US. And you can see how also other countries have lower, advanced countries have much higher debt levels, but stock prices higher, everything financially engineered. And here is where the value is. Growth, as I said, 5%, young populations, not like this in the developed countries, but a lot of young population, which is good. If we go to estimates, still growing for the long term. For the Philippines, I think population positive, big populations with still a lot of room to grow. 275 from Indonesia, 115 million for the Philippines. And here I also want to just touch 300 million people, 1.5 billion people in Asia, growing economically, developing, accessing internet, learning about things. And they are the drivers and will be the drivers of inflation in advanced countries. That doesn't combine well with high debt, and we'll see how it will end up. But for now, this is from a company that we'll discuss just a second, from the conference call. And then the CEO says, I think the yield of 6% plus is in line with the other market players out there. 6% plus yield, 6% economic growth, young population, low debt levels, 6% yield, plus all the growth on top of it. That's a 10% long-term return with stable inflation also. As we see here from the World Bank, stable currency, inflation, declining trend. These are all very appealing, let's say even macro numbers compared to the yield of the S&P 500. 1.33%, market yield in line with other market players out there. 6% yield. And let me just quickly show you the opportunity. If you want to dig deeper, if you want to read my research, you can check everything on my research platform. But here it is. Just give you the overview, then you can see whether you want me to do the research and follow it, and it is now part of the diversified portfolio, or you can do it yourself, depending on how much time you have. So First Pacific is the stock trading in Hong Kong, also Frankfurt, also in the US as an ADR. Over the long term, there have been these cycles of exuberance and then panic, but now we are at a P ratio 4-5, dividend yield plus 6%, and with all the positives that we have discussed. This is a company that has Indonesia food, infrastructure, Philippines, telecommunications, natural resources, solar power plant, whatever. The food is selling noodles, etc. But with growing populations, that should be good. Power stakes, toll roads, healthcare, and other things. All in all, stable, let's say, utility, necessary businesses there, growing steadily, building a power solar plant in Indonesia and a cable to sell that to Singapore. So trading at 30% of book value, which is the discrepancy in the value there, but that's not that important to me. I'm getting 6% yield, and if you look here, just the dividend and fee income is 324 million US dollars. The market capitalization is below 2 billion. That's already what, 14%. They are investing a lot of that money, 150 million invested for future growth, and less of that paid in dividends. So we are looking at 10 to 15% long-term returns from such an investment, and that's exactly what is discussed here. I just gave you 10+%, or you can take the risk of US large that is doing even more than 10% per year, but on no fundamentals, no population, no debt, no macro. So that is the discussion here, and the issue is that value is unliked. It's better to chase Nvidia, Tesla 2 years ago, things like that. I'm just an investor. I will get my, in this case, 6% dividend, with others higher, lower, but I will keep compounding into value, and I hope everyone investing in Nvidia, Tesla makes their money. I have nothing against it. You will likely beat me when there is exuberance, but when there is panic, I will keep compounding my 6% dividend yield, in this case from First Pacific. And that's about it. It's a different philosophy. See what fits you. If you're here, this is a value investing channel. Like and subscribe. Thanks. I'll see you in the next video.